Good day, everyone. Rich Griswold, Griswold Capital Strategies, once again talking about taxes. This particular vlog is very timely in the sense that we're going to be talking about something called capital gains distributions, and they take place right around this time of year, and it can pose what I call a bit of a stealth tax because you really don't know that it's happening until it's too late and you've sent your 1099 off to your tax accountant to prepare your taxes, and want to show you how you can do a little bit of research, a little bit of planning to try to, if not avoid it, at least know what you're in for when it does come to tax time, again, just to avoid any surprises. Specifically what I'm talking about, and as a side note, what I'm referencing here is if you own mutual funds in a taxable brokerage account. So we're not talking about tax deferred accounts. We're not talking about 401k, traditional IRAs, other tax deferred accounts like this. We're talking about plain vanilla taxable brokerage accounts you hold a mutual fund or mutual funds in. And at the end of the year or early following year, you get a 1099, has the dividends you were paid on various investments, foreign taxes paid, etc. Then there's this one line item right here, this line 2A that I've highlighted, total capital gains distributions. And in all the years I've been preparing taxes, I've seen this number at zero or very small. I've seen it in the thousands. I've seen occasionally in the tens of thousands of dollars. And most often what again, from experience, is people will get their 1099s in the mail. They'll throw it in an envelope or a file with the rest of their tax information, W-2s, etc., ship it off to their accountant, and that's the end of it. The tax preparer does the taxes, and of course, all along, too late to do anything about it. So this is how that number is generated on this line 2A. Mutual fund, in order to maintain its status as a mutual fund in the eyes of the Internal Revenue Service, must distribute 95% of its net capital gains every year. And what that means is that a fund manager, person that's responsible for managing that fund, buying and selling in the fund, will take a snapshot of the fund at a particular point later in the year, and they take the net gains, the net losses, net those two numbers together, and if there is a net capital gain, they must distribute 95% of that gain to its shareholders. Some funds will do this semi-annually. Some will do it in June and December, but most often I see it just in December, and they do typically give you at least a few weeks notice. Mutual fund companies will publish something on their websites, an estimated capital gains distribution list that you can look up your fund and see what kind of damage is going to be done there at tax time, so you can plan ahead at least, or at least know what you're in for from a tax liability standpoint. Second point here is that you pay taxes on the capital gains distributions whether you reinvest those distributions into additional shares, you leave them in cash in the account, or you actually draw those distributions out of the account and put them in your bank or go spend them, whatever. I reference this because I've had people say, well, wait a second, I reinvested those distributions into additional shares in the fund, left them in the account. Why do I pay taxes on them? And that is just that's the case. That's how the tax law works, is that if those distributions are rightfully yours, regardless of what you do with them, you have to pay taxes on them. The good news, on a kind of a positive note, is that if you reinvest those distributions into additional shares of the fund, ultimately, when you sell the shares down the road, you will not pay taxes on anything you already paid taxes on. So that's good news, I guess. Third point here, and can lead to some additional unpleasant surprises, is that if a fund distributes capital gains, during the year, and the fund has a down year, you're still going to pay taxes on that, on those distributions. So imagine that you own a fund, has a really bad year, it's down 20, 25, 30, 40%. And then you get a 1099 the following year that shows that you had so many thousands of dollars in capital gains distributions that you did then have to pay taxes on. Not a fun thing, kind of a double whammy there. So just bear that in mind, that while we haven't had many down years in the market lately, it's just something that you need to be aware of. And then lastly, if all of your money happens to be in traditional IRAs or traditional 401k, then you don't really have to concern yourself with this blog. But be aware that ultimately, if you've got a lot of capital gains that build up, specifically long-term capital gains that build up in your IRA or your 401k over time, ultimately, when you draw that money out, as it stands today with the current tax laws, that money will be drawn out and it is considered ordinary income. So it gets taxed at the same rates that your W-2 income gets taxed at, for instance, or your small business income does. And the reason I bring that up is because as it stands today, long-term capital gains rates are much more favorable than ordinary income tax rates. So just bear that in mind. And happy to discuss this with you. Any planning that you want to do, any questions you have, any research you want me to do as far as any potential capital gains taxes that you may or may not be on the hook for, I'm happy to chat with you about that. This is my contact information, my phone numbers, and my email, website, etc. And then, of course, lastly, the disclosure for you to read. And with that, I wish you a wonderful holiday. Please stay safe and healthy, and look forward to my next vlog. Take good care.